Okay, guys, let's take a look at chapter 11, which is the statement of cash flows. This is the final financial statement. We talked about the income statement, balance sheet, statement of owner's equity, and then you have your statement of cash flows. Simply put, where's our cash coming from? As a business, how are we making the cash that we're making? So basically, the statement of cash flows recognizes cash from three different levels of activity. First, you have your operating activities, then you have investing activities, and then finally financing activities. So operating activities are, what are the operations of the company? What do we do as a company? Like a company like Apple, for say, we sell phones, we sell computers, we sell iPads, we sell a lot of different things. So for Apple, their cash would mostly come from their operating activities, meaning the sales of their iPhones, the sales of their MacBooks, the sales of their iPads, things of that nature, and then any other operational type things that they're into on a smaller scale. Then you have investing activities, correct? Right. So investments. What investments have we made as a company, and we're receiving cash from those investments, right? So you got to think about it. Some of these companies invest in smaller companies, they buy smaller companies, and then they get the return from those smaller companies. They own a portion of those smaller companies. So that cash received from those companies would be looked at, from the smaller company, would be looked at as investing activity. This is money that we've got based on investments that we've made, and the cash is coming back as a return on investment. Then you have financing activities. Financing activities is more so loans. You know, we might go take out a loan from a bank and receive $100,000, right? That would be a financing activity because we received $100,000 cash. It wasn't from operating, it wasn't from our investments. We're gonna have to pay this back, but we still got that cash in the door, and that was through some type of financing activity, whether it be getting a loan, doing a refinance, or anything like that. So for the statement of cash flows, there's two main methods used to prepare the statement of cash flows. You have the direct method and the indirect method. The indirect method is the method used by most companies because it's easier to understand. You basically want to begin with your net income and then list out any adjustments that you need to make to get to operating income. Like I said, most companies use this because it's easier to understand, and it's actually, I think, preferred by GAAP and the other financial statement boards, because the direct method, if you use the direct method, you usually also have to include how it would look under the indirect method. So under the direct method, you adjust the income statement items to show direct cash inflows and outflows. So that's a little different. You want to go through your income statement to show what was a cash plus, minus, and then what was a cash subtraction, and then you get to what your operating what your statement of cash flows operating income was. So we'll dive into these two methods separately, but just to overview, these are the main two methods that are used when preparing the statement of cash flows. And then remember that your cash flows, you're looking at your cash from three different levels: operating activity, investing activity, and then financing activity as well.